I welcome everyone to our next panel. I'm really thrilled for this one. My name is Dani Berger. I am anchor of Bloomberg Daybreak Europe. Joining me today is CEO of Schroders, Peter Harrison, who has a very rich history, not just at Schroders, but in the asset management industry as well, previously serving as global head of equities, head of investment, and eventually CEO at Schroders, which he's held the position since 2016. Peter, first off, thanks so much for joining us today.
Thanks, Dani. Great to be with you.
So I feel like I need to start with perhaps the elephant in the room, and that's just kind of this grim day we're seeing in markets. Stocks are selling off, bond yields are moving higher now. Peter, I won't ask exactly what you think is going on in markets today, but it is clear that there is more concern about this inflationary type environment. Is there a sense at Schroders, whether internally or from clients, that the risks that clients want to navigate are changing? And what are those risks?
Well, look, I think the world has been built on a trifecta of low interest rates, easy money, and a sense that any inflation is going to be transitory. And right now we're really starting to test that trifecta. But if the inflation piece falls over, the whole thing falls over. And to my mind, as the more inflation we see, the more worries that it's not a transitory moment in time, the more supply chain problems we see. People are going to fear that this is going to be an end of easy money, an end of low interest rates, and then you start to call into question valuations, etc. So I think it is absolutely the key risk that is on everyone's mind. There's no answers to it yet, but we should expect to see continued volatility as we work through. It's going to be a difficult time.
Does that change in terms of what clients want? Because it used to be, okay, everyone is hunting for yield. It changes the product types. Maybe they're not as interested in bond products. They want dividend payers. Is that still the story, or is that shifting at all?
No, I think fundamentally the needs of people to have return in a very low return world, and having some assurance about how that return will fare as economies shift into the next stage of the cycle, that hasn't gone away. And we all know there's a paucity of return around. So what you're seeing is this much bigger move into private markets, into private debt, etc. And I can see this, just carrying on in the same way it has done, because there aren't any easy answers.
Well, that brings me to one thing I wanted to ask you about, Peter, and that's, of course, Schroders' push into private equity, private credit. Of course, you've been in private assets for some time, but recently you had this rebrand. You've had acquisitions. You've purchased Blue Orchard. What's behind that further move into the private space?
Look, I think you're seeing a lot of client money moving towards private markets. But what's been missed so far is the intersection between these two markets. So we've had two completely different things. We've had a public market and a private market. And our premise is that over time, these two are going to move closer together, and they're going to become more fungible, more tokenized. And having the ability to be able to act across those asset classes will be key to clients. I don't think we should think of the dynamics as separate. So that for us was a big change. The second big change, I think, is more profound, and it's around the fact that asset managers historically have sold a simple thing, which is about performance and risk. And there is a new chapter emerging, a third dimension, which is what's the impact? What are you affecting? What's the real external impact of the businesses you're investing in? And if you think that climate change is going to force us to build the biggest industry in the history of the world, and we've got 30 years to do it, that's a very short period from a historical perspective. Many of those businesses will start private and may well end up on public exchanges. So having impact-related businesses like Blue Orchard, which try and affect positive change, is going to be more and more important for clients. It's huge in Europe. It's growing.
So I definitely want to dig into impact investing, ESG, more. But first, I do just want to bring up a viewer question. This is Marianne from Zurich, and I feel like it fits into what you're saying, and I know you've been very vocal on this topic before. Marianne asks, how can we level the regulatory playing field regarding disclosures, requirements between public and private companies? I know this is something you recently talked to the FT about in terms of sort of leveling this playing field between the two.
It's one of the fundamental issues. If people talk about we want a lot more governance of public companies, but if you end up forcing companies off exchanges into private hands, you end up killing the goose that laid the golden egg, as we say. So to be really thoughtful, both as asset owners and as governments, to say we need to deal with this sustainability issue across all asset classes in every respect. And I think, we have, I think, about 8 different consultations coming from different governments about what constitutes sustainable taxonomies. They're all going to come with different answers. They're going to create a huge amount of complexity. And bringing those together and common standards, common accounting standards, TCFD, et cetera, is going to be really important for everybody. Otherwise, we'll all spend our time forms and not making returns for clients.
Right, and it's important for clients too, right? I was really struck by a poll that Schroders had done, which basically clients had said that greenwashing was the biggest thing standing in the way of their sustainability goals. How big of an issue is greenwashing in the industry?
Look, I think the key is going to be able to have good data. The asset management industry is being asked to produce funds which are labeled as green sustainable before companies have been required to produce the data which demonstrates the efficacy of them. And that's a really awkward position to be put in. So we spend a vast amount of time and effort gathering data to prove that what we're doing is good to label. But it's a challenging position because you're not dealing with real data, you're dealing with opinions. And we know the big rating agencies come to very, very different answers about what is sustainable. So this is a debate which is not going away anytime soon.
What do investors need to do from their side in order to navigate this landscape, in order to navigate ESG products, to make sure that they aren't buying into something which is just green by name only, but isn't actually accomplishing those goals?
Yeah, I think that they need to push for data. They need to push to understand what's the real underlying impact of the businesses in those portfolios, and what impact are they having on society, what are the externalities. Accounting profit is great, but we all know that it doesn't account for the real cost of carbon, the real cost of diabetes, the real tobacco. If you adjust profits for those, you get to what the real impact of those companies are. That's what they should be asking portfolio managers to put on the label of their funds, to know what the impact is.
How do you view this debate that sometimes happens around the ESG world in terms of the best way to enact change as an asset manager? Is it, one, you hold companies which maybe aren't ESG, but you push them to improve, so like a gas or oil giant via proxy votes, or just put your money and lower the cost of capital for our companies who are already doing well in these areas?
I think there's an element of both, but let's be quite clear. Forcing companies to make a good transition is going to be absolutely critical. But I think there are some things businesses do which are unconscionable, and you simply don't want them in your portfolio. So you've got to take off the tail on the left-hand side, and then work with every business which is capable of change into the middle ground. And I think that holding businesses to account, both public and private, is going to be big. But also directing capital to create new industries and new businesses. It's the innovation which is a lot of this. And we shouldn't necessarily assume that the big companies of the past can transform into the green businesses of the future. That transition is going to be very difficult for many of them.
Right. Peter, I want to shift gears a little bit. Perhaps a lot, and talk about London as a financial hub. Schroders obviously has a very rich history of being a public company in London, listing in 1959. In post-Brexit Britain, however, we have seen some of the other cities in Europe, like Frankfurt or Amsterdam, start to catch up when it comes to IPO volume. Are you concerned that London is losing its crown as a financial center?
I think that we've just recently gone through the Lord Hill review, which draws out why London has lost ground, particularly to the US actually, but also and to my mind, many of the proposals that was in the Hill review, I think will hopefully be enacted very soon, and that will help London regain its position. But we've got to be certain that there's going to be good capital flowing to new IPOs. We've got to make the opportunity for dual listed shares to be freely traded. We've got to give founders the time to grow new technology businesses. The UK's underperformed because it's full of the wrong sort of businesses. And what we haven't done is done a good job of attracting those new generation businesses to the UK. That's going to be the critical shift that's required. So the UK, I think, over 10 or 15 years is broadly flat since 1999, whereas the US is up, 250%? It's a massive difference. And that's reflected in consumers' pensions. That's not a great backdrop for them.
Right. And of course, feeds into this idea that more investors want to be in private markets because if you want to own growing companies, perhaps that's where you want to be as well.
Yeah, absolutely. And I think figuring out how you do that well in a tough, tight regulatory environment is a critical
Mm,
issue. And there are um, a number of ways of doing it. And one of the things reason we've moved into private markets is because we see that as massively attractive as private assets get democratized to more
mm,
people and give more people access to it. Because also people can relate better to what it is they're owning as well, because
mm.
they get a share of the action.
I know you've been very vocal in terms of supporting government initiatives in order to open up private markets to different types of investors. Does it seem on your end like we are indeed getting some movement in that direction?
We are, undoubtedly. I think governments everywhere have realized that innovation is such a key part of a dynamic economy, and attracting those businesses through, and particularly, you know, Series A, Series B's been better supported. Series C has been a much bigger problem in the UK. We have the Khalifa Review, which is trying to address that issue. And again, we've launched a range of funds to try and address those specific issues and also capture some of the great businesses that are coming through. But you're absolutely right in identifying the problem, Danny.
So if we can switch back to IPOs in terms of identifying the problem, you mentioned the Lord Hill review. You mentioned some of these potential reforms like dual class structure, having a lower percentage of float. Do the reforms laid out in the Lord Hill review, do they go far enough, or are there things that you would also like to see changed and sort just promote the growth of capital in public markets in the UK?
I think the Hill Review has got it right. I think
Mm,
there's a huge amount of change. What we now need to support is the patient capital required to let those businesses grow. And the UK is in a fantastic position. It's got a really dynamic healthcare sector, science sectors, technology, fintech sectors. We've got the businesses that are being developed. What's happening is they've been going overseas to list. And by just keeping them at
mm.
home and driving London as a place, as a convening place, I think will work very well. But we just need to change the regulations and make it easy for them to list here.
How about the hunt for talent within London as a financial hub? There was a Bloomberg story that was perhaps cheekily titled, it was a lorry driver shortage, bankers could be next, basically saying that European Union international staff make up about a fifth of people in UK financial services industry. Is it getting harder to find that international talent and retain them in a post-Brexit UK?
I may be biased, but I think London's one of the probably the best city in the world to live. I think it's a hugely attractive place for people to come to get educated, and a series of vibrant sectors, whether it be the arts or finance, and that brings people to London. So we're not having any trouble of attracting people here. In fact,
Mm,
to my mind, the frustration is that the stock market isn't reflective of the very dynamic financial sector that we've got, and that's actually closing the gap. Because if you look at every other measure,
mm.
where in other financial sector, in other parts of the finance world, the stock market is not a good reflection of that. We're doing far better from a debt perspective, from an FX perspective. So I'm a huge fan of London.
Well, as am I. I've been here for 4 years, and I'm probably not going anywhere anytime soon. So I can definitely sympathize.
I'm,
I want to
I'm,
talk,
uh,
Peter, about Peter. I want to talk about Schroders in terms of strategy of the overall business. There certainly have been quite a few acquisitions that you guys have made. We talked about Blue Orchard. There's of course Sandaire, the multifamily office as well. How key are acquisitions to growth at Schroders?
I think it's part of bringing in new capabilities. So, to my mind, we started life with a traditional asset management business. We've grown a big private markets business. We're growing a big wealth business, and those two things help accelerate growth and help spread our expertise across more sectors, get us closer to the end consumer, and they are slow to grow organically. So by bringing in a
Mm.
capability and able to launch the next generation of funds and integrate it in is a much quicker way to attain that growth. So they're not seeking to do transformative acquisitions. We've always shied away from the big mega merger, which has been seen elsewhere in the sector. We'd much prefer just to focus on capabilities, and that's driven good earnings growth from those and good follow-on growth.
Does that mean we could perhaps see some more of these types of acquisitions that expand capabilities at Schroders in the near future?
Yeah, absolutely. Absolutely. I mean, we see it as a really good way of getting closer to the markets we want to get and just taking incremental steps. And it's a good source of earnings growth for our shareholders.
What about the industry as a whole? You mentioned the mega mergers that are happening. How much consolidation do you foresee in the industry as a whole?
I certainly expect to see a lot more, but not with asset prices where they are, because this is
Mm,
a easy time. Rising tide lifts all ships. But when we see lower markets, which may well happen, you will see that as a moment where people are forced to look at their cost basis, and if you haven't got growth, it's the answer is cost reduction. To my mind, the secret is investing very heavily in growth when the sun is shining, because that will see you through those difficult periods. So I would expect to see, we saw a transaction with NN being bought by Goldman Sachs earlier in the year. I would expect to see a lot more of those. But to my mind, the business is about growth, not about cost reduction.
mm. And Peter, back in a former life, I used to be an ETF reporter, so you'll have to forgive me for this question, but I feel like I have to ask it. How much of consolidation in the industry is being driven by competition of low-fee passive products and just trying to reach those economies of scale to kind of meet the low-fee environment as well?
Yes, it's exactly the right question. I mean, if you think about it in terms of disruption, a product has come along which is nearly free, and there's a great price war going on in ETFs, which is pushing the price ever lower. And active managers have got a value proposition which is at a higher fee, and that's forcing change. It's forcing price of active management down, and is saying unless you've got very high quality alpha and very good investment performance, there's a cheap, nearly free alternative. So to my mind, that's going to go on a lot longer. The key, to my mind, is as an active manager being able to outperform. And I'm very fortunate that I work with a bunch of investors who've been able to make over 80% of our funds outperform over pretty well every time period. So that puts us in a very strong position. But we've invested
Yeah, I
very
mean,
heavily in data insights, etc., to achieve that performance.
that is exactly what I was going to ask, because I was looking at some Schroders stats before coming in here, outperforming over 1, 3, and 5-year horizons. Also seeing inflows in the first half of the year when a lot of your peers have not. I mean, it's a difficult market environment to navigate. What do you attribute that to?
Look, there's a couple of big things happening. And we talked about sustainability and the fact that clients are demanding a different type of product. And we've been very fortunate that we're leaders in that area. They also want more thematic funds, which tell a story, which, you can invest in climate change, invest in disruption. Nobody wakes up in the morning wanting to beat the MSCI Europe or another index. So they want a product they can relate to. Institutions want their problem solving. They don't want us to say it's just about alpha in this narrow market. Solve my whole problem. Solve my Solvency II problem. And it's the firms that are able to do those more difficult things which are gaining a lot of share. And I think what you've seen in the last 12 months is the haves and the have-nots have polarized very significantly. And you've seen very good growth in some areas and very poor growth elsewhere.
So where are those sort of good growth areas then?
Well, I'd say sustainability, thematic
Right.
solutions, well, ETFs, partnerships where you can get close to the end client. And we've got a great joint venture with Lloyds Banking Group where you can really drive growth through direct relationships with customers. You saw it with Morgan Stanley buying into Eaton Vance and E-Trade. The same trends are evident across the Atlantic. But those businesses with growth get stronger, and those that aren't in those bits of fast-flowing water are struggling to get traction.